Hey everyone, it's Imran from Options Insight, back with your macro options spotlight. Now, before we jump in, if you like these videos, you like this type of content, please like and subscribe to the channel. That will really help us with the algorithm and get more people to see this type of options related content, and it'll really help us grow. Okay, so a pretty bad end to the week. Obviously, as markets were digesting a hawkish Powell and weaker economic data in the US. We also had European stocks hit as well. ECB came out more hawkish than expected, as we flagged last week. And finally, European indices remembered how to move. So on the week, we had Euro stocks and DAX down about 3.5%, which is a much bigger move than we've seen of late, and was about a 1.2, 1.3 sigma move compared to their implied vols, which are just shy of 20. Now in China, Asia, also weak, down 3.5% on the week. Saw some obviously misses there in terms of retail sales and industrial production. And then in commodities, we saw they were softer, but it was a bit of a mixed bag. Metals were down in line with stocks. Copper worst hit there, down 3%. And then energy commodities such as nat gas and oil recovering a bit from recent weakness. And that was despite higher inventory data coming out in crude. So it doesn't seem to really care that much what the inventory data is right now. Crude is kind of doing its own thing. Obviously, it's been pretty weak for a while now, but managing to bounce a bit there. Maybe people kind of getting a little bit more optimistic for next year. If we look at vols, we see obviously US indices were slightly lower. NASDAQ and Russell down. S&P relatively flat on the week in terms of at the money 1 month. European vols did bounce up around 2 vols on the week. And then Asian vols were softer, obviously resetting lower in terms of China from quite a high base at like 36 vol. It is still as things start to stabilize a bit, because obviously China was having massive moves. It's still moving, but not quite as much. Looking at the carry side of things, European carry, we mentioned, flipped into negative after those big moves that we saw post ECB. No real carry to be harvesting in US indices still, certainly not NASDAQ or S&P. So positive carry still in FTSE and Asian indices. If you do want to hunt some theta into Christmas, that's going to be probably the place to go. Looking at commodities, though, we do see gold continuing to move, negative carry of 28, realizing 16 versus implies of 13 there. And then on the positive carry side, uranium has kind of collapsed in realized vol terms down to around 25. So that's providing 35% of positive carry on an implied vol that's at 40 still. But bear in mind, 40 vol for uranium vol is the low end of the range in terms of implied. So that is looking quite cheap. And the thing about uranium is it can gap quite violently when it feels like it. So I wouldn't get lulled into a false sense of security, excuse me, on these lower realized vols. Excuse me. Skew-wise, mixed on the week. Generally, skews are still quite low. We look here on a 18-month percentile basis. They are still pretty low. It shows you that there's little demand for protection. Rather than it being complacency in the market, we see this as indicative that the market is still underweight. Investors are still underweight equities, given that a recession is looming. And that's why there's been no real bid for skew all year. If you look at put skew in commodities, though, we are seeing gold skew bouncing along with silver. So even silver kind of getting quite close to neutral there, whereas normally that trades on a call skew. So those precious metals failed to break to the upside. Gold kind of back below that 1810 area. I mean, it's kind of hanging around 1800. So it may still break, remains to be seen. But the fact that it didn't manage to break on that CPI, people are now looking back down towards the downside there. Okay, moving on. We look at growth is the focus now for stocks. Okay, so what am I saying here? Obviously, Powell surprised the markets being incrementally hawkish in the face of softening inflation data, saying that they need to see substantially more progress on inflation. So that dashed any hopes of an early pause or pivot and a rally in stocks. Okay, rates markets still don't really seem to believe what they're saying, given that they're pricing terminal rates at 4 versus 5, which is what the Fed guided. But equities seem to be finally getting the memo that bad economic data is actually bad for stocks, and easy money and excess liquidity may not be coming back quite as soon as the buy the dip people might have liked. So poor PMIs, disappointing retail sales, evidence evidence of economic surprises rolling over. So you can see the City Economic Surprise Index here flipping back down into negative in the US. We've obviously got a housing market that is looking very toppy, starting to roll over. But, looking at previous sort of declines, people are calling for potentially 10 to 15% type moves. So still a way to go there. And the wealth effect apparently is much more related to people's house prices than it is to their stock portfolios. So if there is going to be a big negative wealth effect drag coming from lower housing prices, then consumer demand may well collapse next year. So that's something to kind of keep on the radar. And then we think stocks are going to potentially react to that. And it's just so Q1 potentially stocks are going to go lower as they price in weaker earnings and this kind of weaker economic data if the Fed isn't just going to be there to bail out the stock market. And that's kind of the way things seem to be shifting towards. Okay, so that move away from inflation and towards growth. Now, as the year comes to a close, the key data out this week is going to be Bank of Japan's meeting tonight. There has been some chatter about them revising their ultra dovish policy post-corona next year, but that has already been denied as well. So who knows what they're going to come out with. China prime rate announcement is also due overnight. And then we've got PCE inflation data out on Friday, which again shouldn't be that market moving. It should really, but we're looking for that to kind of confirm what we've been seeing in CPI. Outside of those sort of macro data points, we do have the VIX expiry on Wednesday. We think this may provide some support to the market, as generally there's been a lot of December calls that have been bought as kind of year-end protection, year-end hedges. And so as these calls evaporate and they go out worthless, the dealers who are long VIX futures against those calls are going to need to sell them, right? And so that should put a bit of pressure on the VIX futures and on volatility in general, and that in theory should support markets a little bit. On top of that, we also have these big end of December JP Morgan strikes, this 38.35 strike that seemed to come into play already on Friday because it provided some support for the market. This is that big put spread collar that we talk about every quarter. The short call strike is that 38.35 strike. So we know that the dealers are long that strike, and therefore they are long a lot of gamma. And that should be relatively supportive to the market on the way down and make it quite difficult for the market to break below 3,800. So that's what we're expecting. And we saw evidence of that dynamic last week where that level supported the market. And at the same time, implied vols were well offered into that downside move, which suggests, yes, dealers were, after last Friday's expiry, the thing that dealers really had to contend with was this large long gamma position. So they were offloading any options they could in December, January, or whatever to get that theta build down, because you don't want to be paying a load of theta into year end generally. So you're going to be selling vol against that. So the kind of price action in implied vol confirming what we thought about the dealer positioning anyway. Okay, in terms of like what I'm looking at ideas wise today. So if we look at the international ETFs and see what have been the performers this year, the EM is standing out clearly as the best performer, right? So we've got these three ETFs, EWW, EWZ, and INDA. So India, Mexico, and Brazil. So they are the outperformers. If we look back to the start of 2022, obviously the things that didn't do so well were the likes of Germany, China, NASDAQ, etc., all down around 30%. But these things managed to do relatively well. So the question is that going to continue? We do think that, the dollar, whilst it might need a short-term bounce from these levels, it may have likely topped as we see the speed of Fed hikes slowing down, whilst it does look like a lot of other central banks are still in need of taking rates quite a bit higher, and that's getting priced into markets. So maybe the dollar has topped. If that is the case, then EM tends to be a reasonably good way to play that. The likes of Michael Hartnett of BofA quite like the EM theme for next year. And if you look at Brazil and Mexico, they have taken some damage recently, right? So Brazil is down a good 20% from those local highs. Mexico is also down a bit as well, probably order of magnitude sort of 7-8%. Whereas India's been holding up relatively well. It has pulled back, so you can't really tell here. It's kind of caught in the mess there. It has pulled back, but it does seem to be on a firmer footing. And if you look at the demographic tailwinds in India as well, they also make a long India trade more attractive. So we do think India's got the potential to rally next year. And we don't mind that as one of the legs to a kind of a longer term bearish dollar view to stick that in the book. So looking at our kind of cross asset dashboard, and then to close it out, we've got this chart from Saxo where they talk about positioning in the dollar. So all the non-commercial positioning data showing that we've had a big flush out in dollar longs. So you see here, this was a dollar long position for most early part of this year. It's got flushed out to a slight dollar negative now. If we look at the breakdown of that, it's because the euro long position has gone back towards multi-year highs. And it's because the short position in yen has been cut in half. So there's clearly been quite a lot of damage done to that dollar long position. A lot of people have been flushed out. The dollar is back to more neutral overall, but that neutrality is coming from a very long euro position. So for those of you who want to fade this move in the dollar, who want to get long dollar, probably the best place to do it is going to be euro, because that's really where the dollar weakness has been coming from. It's been coming from euro strength. And so positioning is a bit stretched in euro. And now that we've got the incremental news out of the ECB, yes, they were hawkish, but that is now priced, and the rates market has priced in quite a lot of action coming from the ECB. Maybe you want to fade it via shorting euro in some shape or form. And we did put out a trade idea on a euro short, on a risk reversal last week about that point. Okay, that's it for today. Hopefully you have a good week. Obviously, there's going to be very little liquidity this week, I suspect. So hopefully you haven't got any big things to move around. That was all last week's action, but we'll still be doing our dailies every day up until Thursday. So we'll catch you here tomorrow. See ya.